I'm going to start talking today using some relevant things about even today's current stock market and so on. Recognize that everything here today is for educational purposes and shouldn't be interpreted as advice for your investment portfolios. The first thing that we always like to touch on is what is a derivative. How many of you have seen Michael Moore's Capitalism: A Love Story? In there he corners some guy on Wall Street and basically is like, "What's a derivative?" And they're like, and he's catching everyone trying to kind of corner him on those things. But a derivative is essentially something from which its price is derived from an underlying asset. So, for instance, a call option on Suncor. The price of that option is derived from the actual movement of Suncor shares. So whether or not that option makes money is based on the stock price, not on the option itself. And that's why it's a derivative, because the price is derived from the underlying. The other thing that we always like to touch on is the difference between trading and investing. And this is something that a lot of even beginners tend to be challenged with, because we are naturally taught within this business to be investors, which is the long-term owners of companies. You research a stock, you learn everything about it, and you own it as a shareholder. And there's nothing wrong with that. But to recognize is that when you deal with options, and options being shorter in duration, they all expire at some point. It in fact is a trading decision, when you're trading, you're trying to profit from a stock move rather than being an owner of a stock. It's a very distinct difference between the two. And what happens is that most investors or even traders, they say, "I'm a trader," until they're losing on the stock, and then they become an investor. It's a very common thing, and really what we have to emphasize, and when we talk about options throughout the session, recognize that we are looking at it from a trading perspective. There's nothing wrong with investing, and if you are an investor, that's not trying to diminish that, but recognize that when we're dealing with options, we're looking at things from a trading perspective. Now, options, when an option comes to existence, it is not something that's issued by the company. Most people, when they know of a stock, the stock at some point had an IPO or a secondary offering, and the company sold shares out there to raise capital so that they can actually run a business. When a call or a put, when you buy a call or a put on a stock, it has the management of the company has no say in whether or not that call or put comes to existence. It's an independent contract that requires a buyer and a seller. What a lot of people don't recognize right off the bat is you could be a seller of options just as easily as you could be a buyer of options. We'll be explaining that throughout the session. It's not like some secretive financial firm out there that's the seller of options, and they're manipulating the prices so that you always have to be the buyer. You can, if you feel that there's an advantage to you being a seller at this point, you can just as easily be the seller of the option as you can be the buyer of that. Now, there are two types of options, but before we get into those two types, I would want to just even give you guys a simple illustration of what an option is. You guys in your everyday lives already experience the use of options. In fact, options really have existed the entire duration of commerce, since the commerce came to existence. Look, for instance, if I was selling my car, and I mentioned to somebody out there that I was selling, and they say, "I might be interested in buying your car." Well, we could just transact some money and I sign the ownership papers and they buy the car from me. But there could also be like, I'm interested in your car, but I don't know if I want to buy it. So what if you give me a $500 deposit that says I have the right to buy this in the next week? If I don't, then you get to keep the $500. What you did was create an over-the-counter call option on the car. You have the choice to buy it, and if you don't, you don't, but you don't have to buy it today. You have the choice to buy it over the next week. So that's an over-the-counter call option. Just the way you would experience that, even new home sales, when you go and buy a house that isn't finished until 2013, your deposit is really a call option to buy the house when it's closing. A lot of people that speculate on real estate like those deals because they put a certain amount of money down and they can achieve a high amount of leverage in flipping a new home. They're in fact flipping call options on homes. These exist in your everyday lives. It's just now what we're talking about is a standardized option that trades on an exchange, that trades on stocks. And we're going to try to find a way to have all of you grasp these concepts, and we'll go into all the details, and hopefully you guys will all leave today being experts on options, right? Now, the one thing I want to emphasize here, there are two types of options. One is a right to buy, and the other is the right to sell. And so when we're talking call options, when you buy a call option on a stock, it's giving you the right to buy an underlying stock. And if you buy a put option, it's giving you the right to sell it. Now, why would we use options? Well, if you are currently a stock trader, right now you're limited only to a basic buy or sell decision. You're either there's no real other choices. Either I own it or I don't. And if you own it, you're taking all the risk of being associated with that stock, up and down, and then at some point you choose to sell it and you're out. When we use options in combination with stocks or just options on their own, it allows us to have so many different ways of making investment decisions beyond the buy and sell decision that a stockholder is limited to. The way I'd almost put it is that a stock investor that doesn't use options it's like a contractor going to every job with just a hammer. Didn't bring a screwdriver, didn't bring a saw, didn't bring anything else. It's just I come there and I do every job with just a hammer. But really, when you educate yourself on options, it's like coming to a contractor coming to a job with a utility belt with all the tools on there. There's a tool for every single situation. Like for instance, right now we've had a substantial stock market rally, and so many stocks have made a lot of money in the last couple of months. And at this stage, buying some protection to lock in the profits that you've made is a good consideration. Particularly, volatility is very low and those options are very cheap. Why would you put yourself at a situation where you're at risk of losing all the money you've made? That's a tool. That's someone who just has the choice of buying or selling a stock has a difficult decision to say, well, I either sell all my stocks and now I'm sitting 100% in cash. But somebody who uses an option as a tool can actually say, well, I'm going to at least lock in some of these profits or find a way to remove some of the risk associated with the market. And that's something that all of you will learn about throughout today's presentation. So with options, it allows us to leverage with a defined risk. In other words, we can participate, let's say, on the upside of a stock with leverage, but we know that we can never lose more than we put into the call option. While if you buy an entire portfolio on aggressive margin, you don't really know how low those stocks will go and where a margin call could come in. But with call options, you know exactly what your worst case scenario is. If you spent $5,000 on call options, you know there's a chance that all $5,000 will expire, but you can't lose more than that. And so you could define that risk. We can also use options to generate income from our stocks through covered call writing and things like that. And we'll talk about that strategy a bit more, but it's a way of creating consistency in the income that you're, or in the way that you're creating income or returns within your portfolio. You could also buy those options as protection. Like we were suggesting just a moment ago, right now, if you felt that some of your stocks have done very well, using some options to lock in those gains is a choice that you have, and you can utilize that. And when you start doing more advanced strategies, like they're teaching in the second half of today's Options Education Day show, you can create different things like spreads and combinations. And what they will do is create a unique trade-off opportunity for what your outlook is on a stock. It's a little more advanced, but it is something that is available to you as you educate yourselves on how to use these options in your portfolio. So what I want to do is we're going to cover option basics here, and we're going to cover just what are these options and how they work. So the first type of an option I want to cover with all of you is call options. Call options are pretty straightforward. It's the right to buy something. When we have a right to buy something at a specific price over a specific period of time. So if we, let's say, bought a call option on, let's say, Research in Motion, and we bought it at the $15 strike price for out to April, and well, until the April expiration, I have the right to buy Research in Motion at $15. The stock could go down, it could go up, it could do all sorts of things, but I have the right to buy it at $15 over the next, let's say, 6 weeks. That's a fixed aspect. Now, the buyer of the call option has to pay money for that right. Somebody has to sell them that option. Remember I said that you could be a seller of an option just as easily as you could be a buyer. Now, the seller of the option collects the income that the call buyer paid, but now has an obligation to sell him those shares if he wanted it. So the seller of the call option has the obligation to sell someone those, let's say, Research in Motion shares at $15 if they wanted it. Now, the key word there is obligation, because the buyer of the call option paid money for the right, and it's their choice if they want to buy the shares or not. And so that's a call option. Now, a put option, in every regards, is exactly the same as a call option. It's just the right to sell rather than the right to buy. Otherwise, they're literally the same. Even the option pricing models determine their price or calculate the same way. It's just now what's happening is that if I bought a put option, and let's say in this situation I actually own the shares, I've actually locked in a guaranteed sale price of where I can sell my stock. Now, it doesn't matter how low that stock goes. If there's another flash crash or another August market decline like there was last year, it doesn't matter. You fixed the price from which you have the right to actually sell your shares. Now, somebody had to sell that put to the buyer of the put. And that person took on the obligation of potentially having to own the shares. The best real-life example would be like you buy, let's say, buy home insurance on your house. You are literally buying a put option on your house that if it burns down, the insurance company is going to pay for it. You've locked in or removed the risk of it. Now, in the same regard, the seller of that option was the insurance company. They said, if I sell enough of these, I'm going to collect a certain amount of income for doing so. Nobody wants to see their house burn down. Just the same way if you buy a stock and you buy protection for it, you don't necessarily want to use the protection because that means your stock is going down. But it acts the same way, like an insurance on your stock, that you can remove much of the risk of actually owning it. Now, when you go to to your brokerage account and you actually load up an options quote, And you'll see that it's quoted on a per share basis. So like it might be quoted for 75 cents or $1 or $2 or some nominal price like that. Recognize it's quoted on a per share basis, but you can only buy a call option or a put option in a 100 share increment. Every one contract represents 100 shares. So that means whatever price you see quoted on your screen, you have to multiply it by 100. So if I see a quote for this option and it costs $1, to buy one call option, which represents 100 shares, will be $100. It's just implied that you do that math when you're looking at those quotes. The only situation where a stock would not have a multiplier like that is during the life of the option, if there was something like a stock split. And the option has to reflect now a different denomination of shares because it came to existence before the stock split. But otherwise, 99.99% of the time, it's always going to be a 100 multiplier in there, unless there's like a restructuring or a spin-off or some other variable that comes in while the option existed. Now, there's two important things to know, is the strike price and the month. Remember we said you have the right to buy it at a specific price over a specific period of time. Well, what happens here with a strike price, we have it determines what price you have to do business. In other words, where do I have the right to buy the stock or where do I have the right to sell it? This is a fixed aspect of an option. Whether the stock is moving higher or lower, the strike price doesn't change during the life of the option. Once you've determined that you have the right to buy it or sell it, let's say at $15 or $10 or $30, that is a fixed aspect. That's the strike price. And it doesn't move like the stock price, it's a fixed. The second variable is the month, and that's the month from which the option expires. And the vast majority of options that exist there are called monthlies, and they're options that expire just once a month. And so right now, if you go on an options chain, you'll see that you can choose March options, April options, May options, June options, like they'll show you by month. The one thing that they don't tell you there, but it is implied, is that the expiration always falls on the third Friday of the month from which you're buying. So you would look at literally what the third Friday is in that month. So if we look here, let's say on the calendar, you can see that you would just simply look on that month, and literally the Friday, the one that's the first red circle on the calendar, that is the day that option is the last trading day from which you can actually trade it. At the end of the Friday is literally the 4 o'clock bell on that Friday is the last moment you'll be able to trade that option. If you, for whatever reason, held that option right up until, remember, you could buy and sell an option anytime you want in the market. There's a lot of traders that will buy it and sell it the next day and just treat it like a trading vehicle. But if you held an option right till its expiration date, and then held it right till its 4 o'clock close, then what happens is that if there's an intrinsic value, we'll talk about that in just a moment, but if there's an intrinsic value on the option, then it will be exercised over that option expiration weekend. The clearing corporation, which we'll talk about a little bit later on in today's presentation, is basically settles out all the options out on the Saturday, and on the Monday morning, you will see all the shares would transact. So if you had the right to buy shares and you held it right till expiration, and then the options were in the money, you would see that that Monday morning, those shares would physically appear in your account. You would actually now be an owner of those shares. We'll talk about that in a little bit more detail right now. What happens is that an option gets exercised. We'll talk about American style versus European style options in just a moment, but recognize is that whether you waited till the very last day of expiration or you chose to exercise it early, which you actually can do, We'll talk about that in a moment. The buyer can exercise the right to buy or sell the stock, and they would literally give the instruction to the broker. Now, if you wait till the expiration date on that weekend, it's implied. You don't need to actually phone them. The only time you have to give instructions to your broker is if you wanted to do it early. If you wait till the very expiration date, it just actually automatically will occur for you. Now, when the buyer of the option exercises their right to buy something or right to sell, an assignment is issued by the clearing corporation. And so the option seller, whoever sold that, whether it's a covered call writer or someone who sold some puts or something like that, the option seller is assigned the exercise notice, and then the assignment notice is received by the seller's brokerage, and the counterparty actually exercises or delivers on the obligation. So if one person owned the shares of Research in Motion in that example, and had a covered call written on the stock, and someone else, a speculator, bought the call options, on its expiration date, if those options had an intrinsic value, then literally the clearing corporation would deliver the shares from this person's account, and Monday morning they're in this person's account. It literally is a buy-sell transaction at the strike price, and that physically does happen. Now, we were just mentioning that what options get expired. Basically, all options that have what we call an intrinsic value, or one of the financial jargon terms we use is the term in the money. I'll explain that term in just a moment. But if an option is what we call in the money, or there's a real value to the option, it will automatically be exercised on the expiration date. If you do not want the exercise to transact, you have to sell the option into the market before the 4 o'clock close on Friday. Like you don't have to hold the option till its expiration date, but recognize if you do hold an option until its expiration day and there's an intrinsic value, then the shares will transact. So you have to close that option if you don't want the shares to transact. A lot of options traders will just use the option as a trading vehicle itself. They'll buy a call option for $1. They'll sell the option a week later for $2, make themselves a return, and never take ownership of the stock. There's nothing wrong with that. But the thing is the reason that option has a value, is because you had the right to buy it. That's why it's worth $2 when you sold it. And you want to recognize that if you held it right till its expiration, you can take on the ownership of the stock, or you could simply trade the option. Now, there are two styles of options, like I was suggesting. The vast majority of the options that are available to you are what are called American-style options. And that's because they have what we call a deliverable, something that actually can physically be delivered. So shares, or an exchange-traded fund like Jason will be talking about in the afternoon, an exchange-traded fund can be bought and sold freely. So what happens is that if you, let's say, go any shares, whether we're talking Royal Bank or TD Bank or any other shares that are available on the Canadian market, they're mostly all American-style options, which means that if you bought a call option that is good for 3 months, and let's say you went out to, or let's say we just bought a June option on, let's say, TD Bank shares. Let's say we had the right to buy it at $60. It doesn't matter, just a nominal price. Now, you have 3 months to buy the shares. But if, let's say 3 days later, you actually wanted to take ownership of the shares right there and then, you don't have to wait till June or numerous months later to actually take the ownership of the stock. You can give the instruction to the broker and to exercise the option, and the next day the stock will appear in your account. You have the right to actually buy the shares anytime that you during the life of that option. That's an American-style option. there's another type of an option that needs to exist, is the European style. And the European style options tend to be associated with indexes and with currencies where they basically don't have a deliverable that can be delivered. Like for instance, if you bought an option on the TSX 60, would that mean if I exercise it that all 60 stocks in the TSX 60 would appear in my account? Like in the end, what happens is that the deliverable is not very transparent. So what they do is they make it a European style option, which can only be exercised on its expiration date, not any time before. And what happens is that it's only cash settled for what you made. So there's no actual shares that will ever transact when you deal with a European style option. So if you made $3,000 on the option and you held it till its expiration, then physically $3,000 would just appear in your account and no shares or stock. But the vast majority of options that you'll ever experience will be American style, which is that the actual shares or the ETF will actually be transacted in the process of trading. Now, an options price, you guys must have heard me earlier talking about that word intrinsic value. So what does it mean when I said an intrinsic value? An option is built of two components, time value and an intrinsic value. And intrinsic value is the realized equity value built into an option. So for instance, if we had the right to buy Research in Motion at $15, and during the time that we own that option, Research in Motion went to $20. We still have the right to buy it at $15. So if the stock is trading at $20 and we have the right to buy it at $15, how much can we make immediately by exercising it? $5. So that option has a $5 intrinsic value. It's like an equity stake in the stock. That part of that option doesn't time decay or expire. That's a real stake. So in that example, if Research in Motion was trading at $20 and you have the right to buy it at $15, going back to that exercise, if we held that right till the Friday of its expiration, would the shares be delivered to you? Yes. They would be delivered to you at $15 because there's an intrinsic value in that option because Research in Motion is trading at $20. It's important that there's an auto exercise because it protects you. It's not like if there was no auto exercise, it's not like you have a $3 intrinsic value in your option and it's like, oh, you forgot to exercise, sorry, you lose your $3. The market makes sure that everyone that's owed something, it's settled out and everyone gets what they deserve. And so that auto exercise is a very important component of that. Now, the time value part of the option is the part that you paid money to actually own the call option or the put option when you buy it. Or if you're the seller, that's the time value is what you collected as income. And so that part of the option decays. That's the part of an option that loses value every day that it expires. We'll talk about option pricing in just a moment, but it's the time, like anyone that's ever seen an option that went from 75 cents and on its expiration date expires at 0, it's because it time decayed. There was no intrinsic value and it time decayed to 0. That 75 cents that in that example is all time value. Right? And now, let's say, back to that Research in Motion example, let's say we had the right to buy Research in Motion at 15, and right now it's trading at 20. If that option was trading, actually I have an illustration of it right here. Let's just use this example. It's easier that way. So if we have a stock that's trading at $40, and we have a call option that gave us the right to buy it at 36, right? We can buy it immediately at 36 and sell it for 40. There's a $4 intrinsic value. So if that option was trading at $4.40, how would the time value versus intrinsic value be split up? Of the $4.40, $4 is intrinsic value and 40 cents is time value. That 40 cents of time value is the part that's decaying. The $4 that's left in there of intrinsic value is like actually owning a part of the stock. It's an intrinsic value, the equivalent of being an owner of the underlying. Now, a put option, on the other hand, is the right to sell something at a specific price. So this is where where a lot of beginners will get confused. Remember now, put option is the right to sell. So if the stock is at $40 and we had a $44 strike put, that means we have the right to sell the shares at $44. If we can go into the market today and buy them at 40, and we could immediately exercise our right to sell it at 44, how much can we make immediately? $4. And therefore, a $44 put has a $4 intrinsic value when the stock's down at $40. You have to remember what your right is. My right is to sell. So if I could buy the stock at a cheaper price and sell it at a higher price, that's where the intrinsic value is. Now that means that a put option moves the exact opposite way a call option does. This is why a lot of traders will use a put option as a mechanism to try to make money from the stock market going down. Because if you own a put option and you're correct about your forecast of the stock market declining, the put option will make money from the market actually going down. And so, and that's because it builds an intrinsic value. Imagine in this example, look at the bottom example there, and let's say that stock went from 40 down to 36. Now you could buy the stock at $36 and immediately sell it at 44, and now the option is worth $8. Because there's an $8 intrinsic value. Do you see how you can make money from a stock going down? Because you build intrinsic value in the option as the stock is declining. This is why people use put options as a way of insurance on their stock. Because if you owned a stock at the same time as owning a put, then you removed almost all of the downside risk of owning the stock. Because whatever you're losing on the stock, you're making on the put. And therefore the put behaves like a perfect insurance policy for the downside risk of owning stocks. We'll give an example of that. Now, options are categorized to identify their current state. This is some financial jargon terms that we like to use in the financial world, in the money, at the money, and out of the money. And this will change as a stock price changes. Now, almost all those examples that I gave you where there was an intrinsic value, remember that research emotion, we had the 15 call when it's trading at 20? When it has that intrinsic value, it's termed in the money. It means that when it's in the money, it means that there's a real value within it. To give you guys a real world example, for instance, in Toronto here, they had condo programs where you could rent to own condos. You could rent it for 2 years, and if you wanted to, at the end of the 2 years, you could buy the condo for, let's say, $250,000. During the life of that, while you're renting it out, if the condo price went from $250,000 to $300,000, and you had the right to buy it at $250,000 for the condo, you're in the money on your condo, right? It's just a terminology that's used to show that your right or your has a value to it that can be realized. An at the money option is where you have the right to buy it at the same price that it's trading at. So, and out of the money is where you actually need the stock to move in your direction for it to become at the money. So you actually need, and those are usually very cheap options. Let's look at an example here. So here's an options chain on call options on Talisman Energy. And at the time when we took this snapshot, Talisman Energy was trading at $18.05. Now, so basically the stock's trade, let's just round it off and say the stock's trading at $18, just so it's easier to follow along. Here, when we look at this example of an August $14 call option, that means that at this moment, if we bought this call option, we would have the right to buy the shares at $14. And where's the stock trading? $18, right? Notice that the bid and ask of that option is $4 to $4.15. Why? Because it has $4 of intrinsic value. If you have the right to buy it at 14 and can immediately sell it at 18, you're going to realize the $4 of intrinsic value. So that option is completely reflecting intrinsic value, and therefore it's coined in the money, right? Now in this example, an at-the-money option is the $18 strike. So if we looked at this call option and we said, we have the right to buy Talisman Energy at $18, and it's trading at $18. Is there any real value for us doing it? Not really. We're right at the money. So the term is at the money when the stock is trading at the same strike price. The stock price is trading at the same as the strike price. Now, out of the money, let's, in this example, look at an August $21 strike call. In this example, we have the right to buy the Talisman Energy shares at $21. But the stock's trading at $18. If the stock went from $18 to $19, would we exercise our right to buy it at 21? No. If it went from 18 to 20, would we exercise our right to buy it at 21? No. If it went from 18 to $20.95, would we exercise our right to buy it at 21? No. The only time that option gains any value is if you're correct about the stock going above $21. Now, the probability of this, in this situation of the stock going from 18 to 21 was so little that option only cost a nickel. Because what the market maker or the option pricing model is telling you is that the actual probability of Talisman in that 1 month that this option was good for, the chance of it going to 21 was such a remote probability that the option itself is like a little lottery ticket. It's worth 5 cents. Right? Because there's no real value to it. And so the options are categorized this way. Now, if the stock went from $18 to $19, what would the at-the-money option be? It would then become the $19 strike. You see how that works? It's dynamically changing based upon where the stock is relative to the strike prices. In the same regard, a put option is very similar, but it's an upside down version of it. Because first off, if we looked at the August $21 strike put, remember, a put option is the right to sell, right? So when we buy an August $21 put, we have the right to sell the stock at $21. Now, if the stock's trading at $18, we can immediately buy the stock at 18. If we exercised our right to sell it at 21, how much could we realize? $3. Notice that the option is trading roughly at $3. It's reflecting the intrinsic value of the put because we have a right to sell. So now what happens is the higher strike price options on puts are the ones that are in the money because you want to be able to sell at higher prices. That's where the intrinsic value is. In the same regard, the at-the-money option in this $18 strike is still 18, right? Because the stock's trading at $18 and the put option at $18 is at the money. In the same regard, though, if we were, let's say, looking at a $16 strike put option, we have the right to sell the stock at 16. If it's trading at $18, would we exercise our right to sell it at 16? Why would we do that? We can sell it at 18. The fact is we need the stock to decline below $16 in order for our right to sell at 16 to be worth anything. And therefore that option is out of the money. So this is just, I wanted to give you guys a little illustration so you guys can understand some of the basic concepts of where you'll see the terminology. If you listen to any options trader such as myself, you'll always hear we're going in the money on this option or out of the money. It's just like one of those terms that you'll have to learn as you become better and better at options trading. The volume is simply just the amount of contracts that are traded that day. Now, the next thing that we want to talk about is there's a terminology used for 1 month and 2 month options called the front month and the next month. So when we're right now, as we're speaking, every option has a front month and so every stock has a front month and a next month option, which means right now if we go get a quote on any one of the Canadian stocks that have options on them, you will see that you can right now have a March option and an April option. Now, every single one will have Marches and Aprils. Now, on the 16th of March will come the expiration. Now, when all the March options cease to exist, you'll see that every single stock now for sure has an April and a May, because the April becomes the front month and the May option becomes the next month. So at every expiration cycle, when 1 month expires, the next month will always be created, even if it didn't exist prior to that expiration. So you'll always have the choice to trade 1 month and 2 month options on stocks. Now, beyond that, each stock, when options become available on that stock, it's assigned a quarterly cycle. And now this is, I think it's randomly done at the time, but once a stock has a cycle assigned to it, it stays like that from that point on. And so right now, if you look at one stock, you'll see that it has options to April and July, while you go and get a quote on another one and you see it only has May and August options. It all depends on what cycle it was actually assigned at its start. And while every single stock will always have a 1 month and a 2 month option, the front month and next month, when you go farther out, you'll see that you have only availability to, depending on which quarterly cycle that stock was assigned for that. So it's just something you'll get used to. But you know, a lot of people say, well, I wanted to write a May one, but there's no May. There's only a June. Well, you know, the May one will come into existence in a couple of weeks, but right now the June may be your only choice. From that cycle perspective. Now there's also what are called long-term options. Long-term options go out to 1 and 2 years. The long-term options commonly have a January expiration. There are some long-term options that will have a March expiration in Canada, but whether it is a March or a January, you can go out to 2013 or 2014, and you can actually take a long-term position in your stock using an option. So it's not always having to be short-term trading where you're talking 1 month, 2 months, or 3 months. You can actually go out a year and a half on a stock and take a decisive position on what your outlook will be over that time frame. This is not available on all securities. It's based on supply and demand, on whether or not they believe there could be a market for that. Now, what is the advantage of these longer-term options? The advantage of the longer-term options is that the time decay decays at a much slower rate. And so therefore, if you had only an option that was good for 1 month, that option will almost in its entirety, or the time value will expire or decay very quickly over the course of that 1 month. While if you buy an option that has 14 months till its expiration, holding it for the next month will have only a small portion of the time decay. And so what happens is that it allows traders to take longer term stances in their positions. So like if you're a technical analyst, most technical analysts have a very short term outlook. Either the stock broke out or it didn't. And so they'll use a lot of short term options. But if you, let's say, are right now trying to call the bottom of the natural gas market, well, you might be waiting for a little while, right? And therefore, you know, if you buy only a 1 month option trying to play the bottom of natural gas, well, you're might experience a lot of time decay. Well, maybe in that scenario, a longer term option makes a lot more sense. So you have enough time to actually see your forecast through. So, longer term options like that are something that is available to you. When you own, let's say, a call option, even though you're participating in the stock price that longer term, you do not have voting rights, nor do you collect dividends. That's something that you should be aware of. But do recognize, and it's actually we'll talk about in a moment when we get into option pricing. Dividends are discounted into the price of the option, but you don't physically receive dividends when you own a call option. So that brings us to wanting to talk about option pricing. And with option pricing is, how is this options price determined? I mean, I think that this is one of those things that a lot of people get a little bit overwhelmed with right off the bat. They're like, I see this price, but where did this price come from? How did they come up with this price? Well, we're going to cover that in a bit of detail. Now, originally, the first option pricing model that came to existence was the Black-Scholes model. There was a Nobel Prize won for designing that. And it's a math model that determines what is the actual probability of a stock actually going or higher or lower, and they need to price an option based upon that probability. The option pricing models input 6 variables. The price of the stock at the time of the strike price from which you have the right to buy it, the time till its expiration, how volatile the stock is, whether there will be a dividend that will be paid during the time that option exists, and what is the current rate of the interest rates. When those 6 variables are taken in and plugged into the math model, they spit out what is the theoretical value of this option. So let's go into a little bit of detail and understand each one of these. Obviously, the first one is price, and it's the simplest to understand. If you actually, let's say, believed Suncor was going higher in price, and you bought a call option, the reason you bought the call option is because you thought the stock was actually going to increase in price, right? The price, where the stock is trading and where you believe it will go, have a direct impact on what an option's price is. And so obviously as the stock price increases or decreases, that directly affects what an option is worth at any one moment. In the same regard, when we were talking out of the money, remember that Talisman example? The Talisman was trading at $18, and then we were talking about a call option at the $21 strike. Well, the strike price was so far away, let's say 20% higher, that the probability that stock would actually make it to 21 was not very good. While somebody that owned an at-the-money option on Talisman at $18, all you need is a small move in the stock for it to now build an intrinsic value. So the price of an option has to be directly correlated with how close that stock is to its strike price, or whether there's an intrinsic value. The next variable is time. And this is obviously, if you bought a call option for, let's say you believed, let's say Suncor was going to go higher. If you bought a 1 month call option, or you bought a 6 month call option, which one do you have a better chance of being right with? The 6 month one. And therefore the option has to be more expensive because you actually have a better chance of being right. What happens is the time component has to be accounted for inside the price of an option. So what happens is that when you're trading and you say I want a 1 month one, well, a 1 month option is going to be cheap because either you're right or it's going to expire. in a very short window of time. And while a longer-term option has to reflect a greater probability that that stock can make a very big move. The impact of time is a function of unpredictability. And the more time till expiration, the higher the premium. So when we were talking that 1 year or 2 year long-term option, recognize that those options are going to be more expensive because, you know what, the stock has a very good chance in 1 or 2 years of actually making the move that you're anticipating. Uncertainty decreases as expiration approaches. And so every day that we get 1 day closer to its expiration, the greater the probability that we know where that stock will be on expiration day. The rate of decay is measured by a Greek called theta, and we'll talk about the option Greeks at the end of today's morning session. But just wanted to mention that in there. Time decay is not linear. Remember we suggested to you earlier that longer-term options have a slower rate of time decay, or what we call a smaller theta. What happens is that the rate of time decay is far more rapid on short-term options. So the shorter you go on the duration of your option, the more speculative the option becomes, because you're either going to be right about the move in a very short window, or the option is going to expire. So while if you buy a longer-term option or sell a longer-term option, you have lots of time for that position to either make money or lose money along the way. So it's not linear. That's the first thing I wanted to point out. The next variable, which is probably in my opinion, one of the most important variables for you guys to learn, is volatility. Now, imagine here, let's just say for one moment that Research in Motion was trading at $20. And at the same time, TransAlta, one of Canada's larger utility companies, was also trading at $20. Now, let's just say we were talking about an option that was shorter in duration and there was no dividend being paid during the life of that option. Theoretically, if volatility was not a part of the equation, then buying a call option on TransAlta would theoretically be the same price as buying a call option on Research in Motion. But yet TransAlta has been within a $2 range for the last 10 years, while Research in Motion moves $2 day to day, right? So what happens is that the options cannot be equally priced. The stock that is far more volatile needs to reflect that it's more volatile, and therefore the option price has to reflect that. And therefore volatility an implied volatility is put into an option. And therefore if you say, I only want to trade options on the most volatile stocks, you also are going to be buying the most expensive options because they have to reflect that that stock is very volatile. The market is a very good pricing system where you really pay for the option its correct price. Well, they try to anyway. It's efficient pricing. So you'll see that a call option on something like a TransAlta would be very cheap to buy because you only need a small move in the stock to make money. While an option on Research in Motion would be far more expensive, and therefore you would need that much of a bigger move in Research in Motion to make money. It's all in the end works out. Now, there are two variables or two ways of measuring volatility. One is what's called the historical volatility. And that's literally if you looked at physically at what the stock has done, let's say in the last 2 months. And you say in the last 2 months the stock was as low as $14, as high as $18. It made this move and that move. It was very volatile. That's using historical volatility. But options they do take into account historical volatility when determining the implied volatility. But an option uses implied volatility, which is a forecast of its future volatility. Now, I'll give you an example. A stock might have been in a sideways range-bound price action for the last month. But if next week it's coming out with its earnings announcement, Understand the earnings announcement in 1 week's time could create a very volatile event. That option is not going to be priced based on what it did in the last month. It's going to be priced on the future thing, that it's about to have an earnings announcement, and there could be a big move in the stock on its earnings announcement. So it's implied volatility is pricing in all known information. So if a stock becomes a takeover candidate, or a drug company is coming out with its phase 3 results, or any variable that is known, that option will reflect all known information, and in the implied volatility. The volatility is important because it's an adjustment for risk. And now remember, you could be a seller of an option. We'll talk about that strategy in a moment. You could be a seller of an option just as easily as you could be a buyer of an option. And so recognize that if you sell a put or you sell a call on a volatile stock, you should be compensated for the volatility that you're going to incur on the stock. Just the same way the call buyer or put buyer needs to pay a premium for owning a volatile stock. And so it's an adjustment for risk. And all known variables are best and most accurately tried to be priced into an option. The goal of in option pricing is to make the option most accurately reflect the probability of something actually occurring along the way. Now the next variable is dividends. And for instance, myself, I tend to do a lot of put selling. I like to sell a lot of puts in my personal portfolios and so on. And I'm always approached at these shows with people and say, well, I only covered call right because I get the dividend. You know, how many of you are already covered call writers in the audience? There's definitely a few. So the most common thing is they say, well, I like to own the stock and sell a covered call because I get the dividend and the covered call premium. And you are right, but one has to recognize that dividend has already been discounted into the option. If you look at, let's say, let's just say a bank stock, a Canadian bank stock, and you're covered call writing on it, and 1 month you turn around and sell a covered call, and you get 90 cents. Next month you sell another covered call, you get 90 cents. But the third month you write another covered call, but this time that covered call is going over a dividend. And suddenly you say, well, why is the covered call only paying 40 cents this month? It's actually because the call is actually reflecting the dividend within it. And in the same regard, if you, let's say we're a seller of puts, if you sold a naked or a cash covered put, let's say on a bank stock, and you got 90 cents, and then another month you got 90 cents, and then you're selling a put over the same duration that a dividend is going to be paid, suddenly that month you're getting $1.40 for the put, while the previous month you got 90 cents. It's because all known dividends are priced into the option. So you can't create an arbitrage opportunity where you can benefit from getting a dividend without it having already been priced in. Because a lot of beginners will say a strategy like this: well, why don't I sell a covered call on my stock, immediately use the money to buy a put on the stock, and then collect a dividend, and I have no risk? Well, that you can't really do that because the dividend's been discounted into it, and almost all benefit of having done that has been removed. So recognize is that if you're trying to come up with some fancy dividend strategy oriented around options, recognize those options reflect the dividend inside the option pricing. That's the most important thing I want to get across there. The last input variable is interest rates. Now, since we really are at such low interest rates nowadays, this has become less and less of a variable in affecting. But if you even think back 20, 30 years when interest rates were, 15% or 17%, back then, if you had a price move, interest rate change, that would actually affect your option quite significantly at the time. But the one thing you want to recognize is that the longer you have an option, so let's say you buy a 1 year or 2 year option, then more the interest is discounted into that option, right? And so really the interest rate component on a 1 month option is not even noticeable. But if you're going out for a 2 year option, then interest rates can be noticed in there. The reason interest rates are put into the option pricing model is again to remove arbitrage. Because once you educate yourself on options, you can realize that you can build like synthetic long positions in stocks and all these other things. And like portfolio managers, if interest rates weren't discounted in there, they would immediately create synthetic long positions and then put the rest of the money collecting risk-free rate of interest, and they would always beat the market. The only way to remove that arbitrage is to discount the interest rates into the option to not allow that to be something that's profitable. The key thing that I want to get across here is that after all of these variables are taken into account, the option price that you're left with is trying to most accurately depict the actual probability of it going higher or lower. All things taken into account, the option is most accurately trying to come up with the best and most accurate price. Now, what ends up happening is that the complexity of option pricing is that now there's a whole series of input variables that you have to take into account beyond that of a stock. If most people make the simple correlation that if I think this stock is going higher, if I buy a call option, I will make money. That's a very basic concept, and we'll say, well, that's what you do. You buy, if I think the stock is going higher, I'll buy a call option. But if you choose the wrong strike, let's say you go too far out of the money and you don't give it enough time, then even though you might be right about the stock direction, you simply weren't able to beat the time decay that was occurring, and you may have been right that the stock moved in your favor, but you didn't make money on the option. This is something that a lot of beginning traders have to really overcome, that initial thing. A lot of the times for beginners, the old saying is always buy more time and always try to go closer at the money so that you don't experience too much of that right off the bat of a bad experience. A lot of speculators will say, well, look, this call option up here is only trading for 10 cents. I like that. At 10 cents, I could buy like 1,000 contracts. But they're not taking into account the fact that it's priced at 10 cents because the actual chance of you making money on that call option is like winning the lottery, right? The odds are that option will expire worthless. And so options, if you go out there and you see an option is very cheap, there's a reason it's very cheap. Right? It's most accurately looking at what's the probability. So what I want to cover with you guys here, we're about 25 minutes away from a break. Let's start and cover some of these different option strategies that many of you can utilize in your portfolio. So now that we got a good solid foundation of what options are, let's actually see how we can use these tools to do some great strategies in your investment portfolios. A lot of these basic ones that I'm going to be covering with you, many of them are actually eligible to be done in your RSPs, tax-free savings accounts, RIFs, your RESPs. Many of these strategies are available to that. Now, we didn't make this an RSP specific presentation, but I do want to draw your attention to the Montreal Exchange education portal at the end, and you'll see there that there's great videos on using these option strategies in registered accounts. So just recognize that you can use these in registered accounts. Now, we're going to illustrate a lot of these strategies using a risk graph. This is a risk graphs are the most common way that a lot of option strategies are illustrated. And to visualize it, they look at the risk and profit potential of a stock. So on the x-axis, you'll see that we have the stock price along the x-axis. Along the y-axis is about how much profit or loss a trader would be experiencing along the way. So the most common risk graph is that of a stock, right? This is the one all of you understand, is that it's a 45-degree angle, which means if this stock went from $40 to $41, and moving to the right on the x-axis, that also means that it moves up $1 in profit. There's a direct correlation. If the stock went up $3, I'm profitable by $3. It's a 45-degree angle. In the same regard, it's a 45-degree angle on the downside, which means if I own a $40 stock and it dropped down to $30, I'm actually down $3 on the stock. Or sorry, $10 on the stock. So it's a 45-degree angle this way. When I put on the risk graphs of the options, always remember this one. Remember what is a long stock one, and look how the option strategy looks in comparison to this one. Now, I don't know how many of you are familiar with the concept of short selling, but short selling is the concept that a lot of pro traders or more sophisticated traders try to do to try to profit from believing a stock will go down. What they'll do is they will borrow shares from the brokerage, sell them with the obligation of having to return them at some point in the future. And if they borrowed shares that they didn't own and they could buy them a month later at a much cheaper price and return them, they can profit from a stock going down. So short selling is something, again, a lot of sophisticated traders use. But recognize a short seller, the 45-degree angle is actually the inverse of the long stock. In other words, you're profitable as the stock is going down, and you're losing money as the stock is going up. So the reason I'm using these stock ones here is because I want you guys to be able to always reference back to the long stock, short stock charts when we look at these risk graph illustrations. Now, buying a call option. So let's go back to the most basic strategy. A call buyer has the right to buy the underlying stock at a specific price over a specific period of time. This creates a risk graph that looks like this. So in this example, let's just say we paid $2 for a call option that gives me the right to buy the stock at $40. Now, if the stock went from $40 to $60, what would we do? We would exercise our right. By the way, I'm going to, for these illustration purposes, I'm going to assume that we hold the option till its expiration and we exercise it. Understand, when you get to trading options, you could buy the option and then later on sell the option, never taking ownership of the stock. I'm just going to, for the illustration purposes, assume that we're going to take ownership of the stock, okay? So here, if the stock went from $40 to, let's say, $60, we would exercise our right to buy the stock at $40. It's trading at $60, so we're sitting on $20 of value, but we paid $2, let's say, for the call option. So how much profit are we left with? $18, right? So what happens is that if I overlay that red line there is the 45-degree angle of the stock. Remember the stock chart had that 45-degree angle? Understand, a call option allows us to participate on the actual upside of the stock from what strike price we bought. Now, what is the advantage, though, of a call option? We might have paid $2, and we could have actually lost the entire $2, but we removed all of the downside risk of stock ownership. Now, how many of you have a stock in your portfolio that you bought at $40 and it's now at $10? No one wants to put up their hand. That's, I understand. No one wants to, but all the giggles, I know that there's a few guilty parties in the audience. But recognize is that when you own stock, you actually have all of the downside risk of stock ownership. when we owned this call option, to participate on the upside, and we paid, let's say, $2 to own it, we know we cannot possibly lose more than $2. So what happens is we've removed the risk of catastrophic loss. Now, of course, if you take your entire life savings and you buy nothing but call options, then all of it could expire, but I'm not implying that that's a good idea in any way. But recognize that if you bought these call options and you were prepared to, let's say, risk $1,000 on buying some of these call options, then that's a risk that you were willing to take, and the loss cannot possibly be worse than what you paid for the call option. That's something that a stock owner cannot say, right? Now, so let's look at an example of buying a call option. So here an investor feels, let's say, that Suncor will rally higher over the next few months. So rather than outlaying the money to buy the shares, the investor decides to participate using that call option. So at the time of this example, Suncor was trading at $30 when we built this. So Suncor here, now in this illustration, we're going to talk 5 call options, so 500 shares. So a call buyer would that, let's say, at $30 bought 500 shares would be outlaying, the $15,000 to own the shares. Here, a 6-month $30 call option on Suncor was asking $3. So here, the call option, a call buyer could rather buy the $3 call option and have the right to buy the shares at $30 over the next 6 months. Now, that means that the average cost for owning the shares will be $33 because we paid $3 for the call option. Our break even becomes $33. So if we bought the stock at $30 and paid $3 for the call, $33 is our break even. Everyone understand that concept? Now the investor buys, let's say, 5 call options, and now it costs them $1,500. Now, I don't know how many of you follow Suncor, but the other year, Suncor went from the mid-40s down to the mid-20s in stock move. A stock, even as conservative and blue chip as Suncor is, can lose a substantial amount of money in a 6-month window if you're wrong. And so here, somebody that, let's say, bought $15,000 of the stock, how much of that $15,000 could they potentially lose? A chunk of it, right? Like, could you be down $7,000 on your Suncor investment? You could be. I'm not suggesting that that would be a certainty, but you could lose that amount of money. Here, by outlaying $1,500 for the call option, this call buyer cannot possibly lose more than $1,500. There's no circumstance where you could lose more. So you don't have the same risk as stock ownership. Now, 6 months later, let's say Suncor is trading at $40. So you were actually right about your forecast, and in that 6 months, that stock had a fabulous move. Now, if you had the right to buy it at $30 and it's trading at $40, what's the intrinsic value on the call? $10, right? Because you can immediately realize that $10. You can either sell the option for $10 in the market, or you can exercise your right to buy it at $30, sell it at $40, and realize the $10. Now, you paid $3 for the option, which means that you're left with a $7 profit. So you were able to actually participate on the upside potential of Suncor, but never having risked more than $1,500, and yet you had all of the upside participation very similar to that of the person that actually physically owned the shares. So a lot of people use these call options as a mechanism for managing risk. In this scenario, you didn't have to necessarily even be leveraged. What if instead of spending $15,000 for the shares, what if when we buy these call options, we take the remaining $13,000 and change and buy a money market fund? in the end, now we know that there's no way that this $13,000 could ever be lost. And we've already tabled what is our worst case scenario, which was $1,500. So people can use the call option as a mechanism for always defining what your worst case scenario is while you're trying to participate in the markets. All right, welcome back from the break, everyone. So what we want to do is carry on from where we left off. We were talking about different option strategies that you can utilize. And we were talking about the idea of buying a call option as a way of participating in the upside potential of a stock. Now, what I wanted to do then is to touch on the idea of selling a call option. And the word naked is used in there. When you sell a naked call option, it means that you have nothing collateralizing your obligation, and therefore you're exposed to all of the risk of the obligation. So what happens is that if the call buyer had the right to buy the shares, the seller of the call option had the obligation to sell them the shares when they wanted them. Now, what this does is it literally creates an inverse chart, like literally turn it upside down, the call buying one. What you want to realize is the options market is really a zero-sum game. Whatever the call buyer is making, the call seller is losing, and whatever the call seller is making, the call buyer is losing. And you can be either the buyer or the seller, but recognize is that the amount of money you're making or losing is inversely correlated. So notice here, when the seller, notice here that when the stock was actually going up, someone who is naked the call is losing money as the stock is increasing in price. And that can go to infinity, as a stock can go as high as it wants, and you would be obligated to sell someone the stock at that fixed price. Now, the more common way of selling call options is not naked, but rather covered call writing. Now, covered call writing is where we actually sell the call at the same time as actually owning the stock. Now, this is a strategy that I even personally utilize a bit. I publish a whole newsletter on the idea of covered call writing, and the idea here is that we physically own the stock. And what we do is we give a speculator the right to buy those shares from us, and we collect a fixed income for doing that. What it does is it creates consistency. I'll talk about it more in detail during the illustration, but I want to point out that it creates this type of a risk graph. And what you'll see is that, and I want you to remember this, because what you'll see is that this risk graph is identical to the risk graph of selling naked puts or cash covered puts. So remember that, just take a snapshot of this, and we'll talk about that when we get to that put section. Now, here, recognize we own the stock, right? We physically own the shares of the stock, and therefore we have all of the downside risk of actually owning the stock because we actually own it. Right? So just that 45-degree angle, if we own a stock and at $50 and the stock drops to 40, we're down $10 on the stock, right? That's that 45-degree angle lower. Now the upside, though, has been cut off. The upside has been cut off because at some point the speculator will choose to want to buy the shares from us. And so, therefore, all of the upside belongs to the call buyer, right? And because we sold the call option and giving us the obligation to sell our shares to that person, we've cut off the upside potential. A lot of people will say, why would I do this? Why would I take all of the downside risk of owning stock and yet cut off the upside potential? And what you'll see is that the concept is really about winning the game with base hits rather than home runs. I'll explain it in a moment through an illustration. Let's look at an example, and then you guys can see what I mean by that. Now let's say the investor feels that the stock market will have a few months of choppy price action. So not anticipating the stock market to do anything substantial. Investor feels that making an upfront return is better than anticipating the market to actually go higher. And they would like to make a fixed cash flow return. So in this example, let's say we are taking shares of TD Bank. And at the time of this example, it was trading at $77.50. Now, the investor would like to buy the shares or could have already owned them. You don't need to buy the shares the same time as you sell the call. So you could have held your TD Bank shares for already 6 months, and now you decide to sell the call. There's no rule saying that you can't, yet you have to buy at the same time. But now the investor would like to create a static income. So in this example, the investor is looking at a TD Bank $78 call option for 2 months. Now it's showing a $2.10 bid. Now recognize, just like a stock, there's a bid and an ask. When we are the sellers of an option, we have to sell to the bid if we want to be filled. So right now, in the open market, it's bidding $2.10. So investor buys, let's say 200 shares of TD Bank. Remember, we have to physically own the shares here. And we buy $15,000 of the stock. And then the investor sells 2. Now we're the sellers of options now, selling 2 of the $78 strike call options for $2.10. What you will see, now when we were talking about the call buyer, let's say you were the other side of the coin and you were buying the call options, you physically would have had to pay $420 out of your pocket to buy those call options. That money would leave your account. You physically bought them. When you sell the call options, you would literally see $420 appear in your cash balance immediately. Not 2 months from now, not at some later point if the stock does something. Today, right now, when you physically sold that call option, $420 just physically appeared in your account. And if you don't do any offsetting transaction, you are guaranteed to keep the $420. You physically made money for certain today. The stock might go up, the stock might go down, but you made $420. Now that represents 2.79% return, cash flow return in 2 months. Now, if every 2 months you collected 3%, how much would you have collected over the course of a year? 18%. How many of you made 18% in your mutual funds recently? Right? What happens is that some people say that 2-3% here and there, but recognize the people that run a covered call portfolio are saying, I want to win the game through base hits. Make 2% here, 2% there, 2% here, 2% there. And over the course of a year, I've collected 10% or 15% or 20% cash flow from doing this. Now, though, we have an obligation to sell the stock at $78. That obligation, we got paid for that obligation. Then if a speculator was correct and TD Bank went to $82, we have to honor our obligation to sell them the stock at $78. There's a catch to it, right? But in the end, you made 2.79%. The whole philosophy behind covered call writing is just that of being consistent. How many of you have ever held a stock that when you bought it, 2 months later, it was at the exact same price that you bought it at? Happens all the time, right? Well, here, this person made $420 in that 2 months that stock did absolutely nothing. Ultimately, it's a strategy of that you don't even need to be right about the stock direction to make money. You're always just consistently collecting cash flow. And there's a lot of merits to that strategy. I consult a lot of people on doing these strategies in retirement accounts and RIFs and other things. A lot of people right now are not happy that they're making 1 or 2% on a GIC. Over the course of a year. They need to live off their money, and they need to be able to make a decent return so that they can actually use their retirement savings. And covered call writing, owning a bunch of great blue chip stocks, collecting dividends, and collecting a little bit of covered call premium generates an income that someone could actually live off of during that time frame. So in this scenario, the investor made, it should be $420, that's a typo there, but 2.79%, and is obligated to sell the stock at $78. It's a process of winning the game by base hits rather than home runs. When you're a covered call writer, it's just, you're never going to make 30% in 1 month. It's because you've cut off all the upside and you gave that upside to a speculator. But what you're doing is you're consistently making a little bit of money over and over again. And for some people, they like consistency in their investment portfolios, right? Sorry? The observation here was that you also made some money on the stock. Yeah, well, we bought it at $77.50, and we had the obligation to sell it at $78, so you would have also made a 50-cent capital gain if the stock did get exercised, absolutely. And if you sold an $80 strike, you would have had further upside on the stock. So that is always something that you can take into consideration, absolutely. The question from the audience was, what happens to the dividend? You are the owner of the shares. And therefore, the majority of the time, you will receive the dividend. Recognize that that is not a guarantee, because most of them are American-style options. And if at some point your option was in the money, the buyer of the call option could choose to exercise it on its before its ex-dividend date, so they receive the dividend. So you're not guaranteed it. But I would say even 9 times out of 10, you are the owner of the stock and you will receive a dividend, but you just can't think that it's guaranteed that I will always get the dividend. So the next strategy, in this afternoon session when Jason comes up, I think that when he's looking at some of the option strategies you can do with your exchange-traded funds, he's going to cover that covered call writing illustration with some exchange-traded funds. So you guys will have some further illustrations on that. And what's nice is that now that options are available on exchange-traded funds, you have the benefit of the diversification of things like the equivalent of mutual funds, but yet you can generate income and cash flow and things like that, or protect them with options, something that you can't do with mutual funds. And so for those of you that want to learn more about that stuff, the afternoon session, Jason will do a great job covering a lot of the topics there. So what I want to talk now about is buying a put option. Now, buying a put option, the put buyer has the right to sell a stock at a specific price over a specific period of time. So notice here that in this illustration, that red line was the 45-degree angle of a short seller's. Remember when I gave you guys the long stock, short stock illustration on the risk graphs? Well, here you can see that by buying a put option, we are allowed to actually participate on the downside forecast of a stock without actually being short the stock. So if let's say any of you were at the conviction that, look, the stock market has gone too far, at some stage here there will be a stock market correction, you could buy a put option to try to profit from your outlook that a market correction may be coming. Again, that's illustration and not advice. But nonetheless, you can use a put option to do that. And so notice, though, that the hollowed out triangle on the chart is illustrating the fact that you cannot lose more money than you paid for the put. So while a short seller has an infinite risk of however high the stock goes, they're losing money because they borrowed shares that they have to return. What you want to recognize is that the buyer of the put can never lose more than they paid for the put. So if you paid $2 for a put option or paid $200 for one put, you cannot possibly lose more than $200 if you're wrong. And a lot of people like that risk management aspect of it. So let's look at an illustration here. Let's say an investor believes that the stock market will seasonally decline. Let's say this is May and you buy into the sell in May and go away story, and you think that the stock market after a high will have some sort of a market correction. And so let's say the investor would like to use the option to participate on the downside forecast of the market. So in this example, we're going to use an exchange-traded fund. Let's say you're looking at the iShares S&P TSX 60 ETF, which is called the XIU. And it's basically a basket of the 60 largest Canadian stocks. So you're just looking for a stock market decline, so you're using an exchange-traded fund that allows you to participate that way. At the time of this illustration, that XIU was trading at $17.67. The investor would like to participate on the downside. So in this situation, this trader is looking at the XIU $17.50 strike put for, let's say, 2 months in duration. So they're looking for that. Now, by us buying a $17.50 strike put, we have the right to sell the XIU at $17.50. That's a fixed aspect. For that, the asking price of that option was 40 cents. The put option gives the investor the right to sell the XIU at $17.50. So the investor buys 10 put options, which cost them $400, right? So at 40 cents, it's $40 for each option contract. 10 of them cost you $400. So 2 months later, let's say that the stock market had a 5 to 10% market correction and is trading at $16.50. So the XIU dropped from, remember, it was trading at $17.67, and now it's trading down at $16.50. And you were right, the stock market did decline. So in this situation, you could just sell the option for $1. Why? Because the market is trading at $16.50, but you have the right to be able to sell it at $17.50. So now that option that you paid 40 cents for is now worth $1. Now, you could turn around and just sell the option for a 60-cent profit or a $600 profit, or you could physically buy the XIU shares and exercise at $16.50 and exercise your right to sell them at $17.50 and realize the same $1 profit. You can either just sell the option or you can exercise it. It's your choice. One way or another, you're going to be left with the exact same outcome, that you realized $1 and which for something that cost you 40 cents, and you're left with $600 profit. All right? And so the put option was used as a vehicle to actually profit on the downside. Now, the alternative way, there's a question in the back. Go ahead.
Can you discuss the liquidity of options?
The question there is about the liquidity of options. What I will actually do is we're going to be talking about those things actually a little later in today's presentation. So if I don't address the question in the slides over the next half an hour or so, then you can re-ask me the question if I didn't answer it in the slides. So now, when we buy that put option, in the first example there with the XIU, we were actually buying the put as a speculation that we felt that the stock market was going to decline. We didn't actually use the put option as a protection or as an insurance policy. But what if we actually bought or already owned shares and we felt the stock market was going to decline? Well, now we can actually buy the exact same put and use it rather as an insurance policy on the stocks that we own, rather than as a speculation for making money on the downside. So in this, because remember, the put option gives us the right to sell the stock at a specific price over a specific period of time. So what happens, buying a protective put caps the maximum loss that you can incur while leaves you all the upside potential. What chart or what risk graph looked identical to this one that we already covered? Buying a call option. What you'll realize is that buying a call option or owning a stock and buying a protective put have actually the identical risk profile. They're synthetically identical. So if you buy a stock and you buy protection on it, or you alternatively don't own the stock and buy a call option, you in fact are doing the exact same thing. You're going to literally get the exact same outcome. On this risk graph, it's the same thing. You can only lose so much on the downside, and you have all the upside potential of the stock if you're right about your forecast. So by buying the protective put, we've removed all of the downside risk of stock ownership beyond the cost of the insurance. So let's look at an example. Let's say an investor owns shares of Gold Corp and really believes in general that over let's say the next 6 months or year that owning Gold Corp will be good, and they want to continue to own it. But they felt that on the short term, over the next few weeks or months or so on, that there is a risk that Gold Corp could go down. But they don't want to be short-term market timers. They just want to add some sort of protection that if there was any short-term decline, they were protected. So in this scenario, Gold Corp at the time, they had 100 shares. It was at $46. A 3-month $46 put option was costing $3. So you could turn around and pay $3, and now for the next 3 months, you are guaranteed to be able to sell the stock at break even. There's no way you can lose more than the $3. Now, what happened, the put gives the right to sell at 46, and so the investor buys that one put option for $300. So now, let's say 2 months later, the investor is wrong about his seasonal outlook, and Gold Corp drops from $46 all the way down to $39. Can Gold Corp do that, by the way? Absolutely. I don't know if any of you trade the stock, but a $7 swing in this stock is quite common over a 1 month or 2 month cycle. So in this situation, the stock actually dropped. Now, an investor gives the broker instruction to exercise. Now, you could hold it right till its expiration date, which was 3 months, but we can exercise it any time we want. So you could pick up the phone, call your broker, or their options trading desk at your brokerage, and say, I want to exercise my right to sell my Gold Corp shares at $46. Not at $39 where it's actually trading physically right now. So you could sell the stock at 46, and how much did it cost you? $3. You're not down $7 on the stock. You lost the $3 it cost you to buy the insurance. Alternatively, you can just continue to own the shares down at 39 and simply sell the option for a profit. In this illustration, I have the option trading at $7.10. So if you paid $3 for it, you could sell it for $7.10 into the market and realize a $4 profit on the put, and then just continue owning the stock. So you don't physically have to always choose to sell your stock. Recognize that you can use it as a hedge, as a mechanism for having removed some of the downside ownership of the stock. Now, why is this strategy important? Why is it important that you guys bothered to learn this? Now, I personally have trained thousands and thousands of traders through our programs and other things like that, and speaking engagements and so on. And I've met all sorts of traders, and I've learned what the natural tendencies are of traders and investors. And I'll give you an illustration of the most common way that an investor thinks. And many of you will very much share the way that I describe the story. So an average investor will go out and they'll say, let's just pick a Canadian stock. Let's say a volatile, let's say Research in Motion, just for so we are consistent with our examples. And let's say the investor says, you know what? Down here, I'm just going to say it's $15. Down here, $15, Research in Motion is a fabulous buying opportunity. Like, look how cheap it is. This is great. They'll turn it around. So you can go out there and you buy the shares at $15, and you say, listen, if I can just make 10% on this stock, if I can even just sell it at $17, I'd be happy. I'd just turn around, sell it. Everything would be great, right? So you buy the shares, and the stock goes from 15 up to $15.50. And you got this smile on your face. Look, I bought the stock. I thought it was going to go higher, and it did. This is fabulous. I love the stock market. This is great, right? So you turn around and you own the shares. Now it goes to $16, and now you're even happier. This is fabulous. I could do this for a living. This is great. Then it goes to like $16.50 and then $17, and you're like, oh, this is fabulous, right? And suddenly this little birdie that's sitting on your shoulder is whispering in your ear, take your money, take your money. And you're thinking, yeah, I said if it goes to 17, but it feels so good making money. So then you turn on the TV and some hotshot analyst in a Brioni suit walks out there and says, we're setting an 18-month price target on Research in Motion at $25. And you're like, cha-ching. If this stock goes to $25, I can redo my kitchen, I can go on this vacation, I can do all these things. So do you sell it at 17? Oh, no, you don't. No, you don't. So then, the next day it goes to $17.50, and you're like, I told you. See, if I'd sold it at 17, I wouldn't be making money now that it's at $17.50. And now you're saying, see, it was good that I didn't sell it. Suddenly, some announcement comes out from the company. Next morning, it opens at 16, and you're like, why didn't I just sell it at $17.50 yesterday? I would have made my profit. I knew what I wanted. It's like, but I can't sell it at 16. If it goes back to 17, I'll just sell it. Now, next day it goes down to $15. And you're like, I could have just sold it at 16 yesterday. Now I'm a break even. I've been in the stock for a couple weeks. I can't sell it now. I break even. If it goes to 16, I'm just going to sell it. Next day it goes down to 14. And you're like, I can't believe this is happening. I knew I should have sold it at 17, and I didn't listen to myself. And you're thinking, this is horrible, right? Next day it goes down to $13.50, and now you're just like, I don't even want to watch this anymore. Now finally you say, listen, if this stock just goes back to break even, I'm just going to get rid of it, and I'm free and clear, right? Suddenly it goes from $13.50 back to 14. I'm like, finally it's going back. Then it goes to $14.50. And you're like, look, it's finally coming back for me. Then it goes to 15. But you're thinking, well, if it's going up, let's see how far it will go. So do you sell it at 15? Oh, no, you don't. Then it goes to 15 and a quarter, and you say, see, I told you I shouldn't have sold it at 15. Then 3 months later, you own it when it's down at 11, and now you're a long-term investor. This is a story that is the most common way of describing all investors in general. And the thing is that what I described there is an investor that is really not in control at all. They're basically strapped into the roller coaster ride of the stock market, and they're a helpless, involuntary passenger while the stock takes them on a big ride. But let me ask you something. When the stock went to 17, and you turned around and you bought a protective put, locking in the $17 strike price, and you paid $1 for it, And now you're guaranteed over the next month to sell the stock at 17. Let's just see if it goes a little higher. Then suddenly the stock drops down to 13. Well, I'll sell it at 17. I'll buy it back at 13. I'll buy another protective put down there and see what happens. And it goes to 15. You lock that in. What's happening is you're using the option as a risk management tool to actually stay completely in control of your trading, allowing you to participate. You'll never make as much as just owning the stock, but you can actually put certainty into your trading, where I am guaranteed I can sell the stock here. I can know this for certain. The thing is that if you just own stocks without incorporating options with them, you're not in control at any point. Now suddenly you combine options with stock ownership, and you suddenly can be in control. And that is simply one of the most powerful aspects of options. It's not about the fact that you can leverage 100 to 1 and make an absolute fortune off of a $1,000 investment. It's about the fact that options are a tool. And when the tool is used accurately, it allows you to control the way that you behave in the markets. And that's, when we educate you guys, that's our objective of what we want to do, is allow you to see the value of using these types of strategies in combination with the types of investment things you can do. And things like this buying protection is something available to you in your registered accounts. Like if you plan to live off of your RSP, can you afford to see it lose 30% of its value in a stock market crash? There's certain times that building a protection into it makes a lot of sense, right? So now what I want to talk about, the next strategy here, is the idea of, let's say, selling a put option. Now, selling a put option, remember, now we're obligating ourselves now to buy the stock, because the person that bought the put option was using it as an insurance policy, right? So we're like the insurance company. We're now selling premium, collecting an income for taking on the obligation of potentially having to own stock in the future. Now in this example, it creates a risk graph that looks like this. Now, do you guys remember what other option strategy had a risk graph that looked like this? Covered call writing. Recognize that covered call writing and selling put options are synthetically the same risk profile. There are certain things like that change the variables of things like margin requirements or option approvals and other things. But if you just look at the strategy in its purest form, selling a put option has the identical risk reward profile of that of a covered call writer. So if in fact you, in the earlier part of the presentation, liked the idea of that covered call strategy we did with TD Bank, and you said that makes sense, but then you turn around and say, well, selling a put option, no, that's risky. Well, you're lying to yourself. The fact is that it's synthetically the same thing. If you like covered call writing, selling put options is a very viable strategy that you can do. Now, if you sell a put option and you don't have the money to buy the stock, that's what is called naked, just like a naked call. Now that's different. There in that scenario, you're using leverage, and leverage in itself is very risky when you're getting to margin. But if you actually had the money to buy the stock, if the stock was put to you, that's called a cash covered put. And there's nothing that's risky about that, because you were ready to own the stock and had the money there to actually own it if it got put to you. So recognize is that the only aspect of put selling that is risky is if you decide to use excessive leverage. And that's because leverage is risky, not because put selling is risky. If somebody sold $300,000 worth of puts with $100,000 in their account, well, it's not the naked put that's going to kill you. It's the fact that you're leveraged 3 to 1, right? That's a margin issue more than anything. So let's look at an example here. And let's say an investor feels that Tim Hortons has gone too far on the upside to buy it now. So you don't really want to buy the shares. They're currently trading at $47.85. And an investor would like to make some money while waiting for the stock to pull back, because at some point they want to buy the shares. They want to own it, they just don't want to own it up here. So what this investor does is sells some Tim Hortons $46 strike puts for 2 months, which were showing 65 cents on the bid. What they literally said was that I don't really want to buy the stock at $47.85, but if the stock pulls back down to $46, I'm willing to own it down there. So they're actually using the put option as a mechanism of accumulating the stocks on pullbacks at levels where they're willing to own the stocks. Now, the seller of this put has the obligation to buy those Tim Hortons shares at $46. Somebody who bought those $46 puts is using that as an insurance policy to protect the downside risk of owning those shares. It all depends. The market is made up of an infinite variation of investors that have different outlooks. One person wants to buy the stock down there. The other person wants to insure the stock down there. That's what makes a market, is that everyone has a different outlook. In this situation, if you were exercised and were forced to buy the Tim Hortons shares at $46, you collected 65 cents income. So your break even is actually $45.35. So basically, you're saying that I don't want to buy the stock at 47 and change, but I would be willing to own it at an average cost of $45.35. There are a lot of investors that use this put selling even as an average down strategy. I'll give you an example. I know one of the investors I was working with had Suncor shares up around $40 a share last year. And then there was that big August market drop, and Suncor shares went down to the mid-20s. What this investor did was they turned around and sold Suncor $20 strike puts and collected an income for doing it, saying that if Suncor went down to 20 and they were obligated to buy the shares at 20, then they would own some shares at 40, some at 20, and their break-even average cost base would be $30. So they actually sold the puts as the level where they were ready to average down on their stock position, right? Now, Suncor never went down there. It reversed and went up, and they got to keep the income for selling the puts, which brought their break-even on their original shares down. So they used the put selling as a way of, in advance, locking in where you are going to average down on your stock position. Again, that wasn't leveraging in any way. That was simply a mechanism where the trader used it as a strategy. And this is why I want all of you to take the time, and I commend you all for taking the time to come here and educating yourself on options, because once you truly learn how to use them, you'll never go back to being just a buy and hold investor. You're going to learn that there's so many different things that you can do about your investment outlooks and different ways that you can achieve your returns, that you'll just get addicted to using options within your investment portfolios, not for leverage and risk, but for management of risk or creating income or doing all sorts of different types of strategies that are available to you. Nonetheless, in this example, the investor, let's say, sold 5 puts on this Tim Hortons. And they collected $325 income, or 1.48% cash flow, for obligating themselves to own Tim Hortons. If Tim Hortons never went down there, they would have just made 1.48% cash flow in 2 months, right? If you do that consistently, you might get 9-10% a year in cash flow from selling puts, even if the stocks never get down there. So what happens is you can create an income on selling puts on your favorite stocks, saying that if they get down there, then I'll buy them, right? It's just, again, one of the many choices of things you can do as an investor. So now let's just say there was a market correction. 2 months later, Tim Hortons declines 10% and is now trading at $44. Well, recognize the person who bought the put option as protection is going to want to exercise their right to get out at 46. So you have to take on the obligation of owning the shares. So you therefore accumulated and bought the shares at $46, not at the current 44. The strike price was 46. You're obligated to own it at 46. So in this scenario, your break even becomes at 45.35, and now you own the shares, and you're down $1 temporarily on them. You could cover call right on them. You can do all sorts of different things, but you didn't buy the stock at 47.85. you bought the stock at a cheaper price. So some people like that as a strategy. Not for everyone, but it's definitely something that you can consider if it makes sense to you. So the next thing I want to talk about are options orders and clearing. And we want to talk about how the options market works this way. Now, some of you may have already placed options trades and know what it's like to do so, but I would say a good handful of you have never used an option or placed an options trade. So I wanted to just take a moment to talk about the idea of placing an options trade. Now, when you buy or sell an option, then you literally are doing a buy or sell the same way you would buy or sell a stock. But in the same regards, a brokerage will require that you specify whether this is an opening transaction or a closing transaction. Because remember, you could be the seller of an option just as easily as you could be a buyer. So if you sell an option, like a put option, like we did in that Tim Hortons example, you're selling the option as an opening transaction because it's appearing in your account. In the same regard, if we owned a put and we were selling the put to close it out because we wanted to get rid of it, we would be selling that put to close it. So you actually have to specify to the brokerage in the trade ticket whether it's an opening transaction or a closing transaction. The simplest way of knowing the difference is ask yourself, is it coming into my account or is it leaving my account? Because if it's something that's a transaction that's appearing in my account, it's an opening transaction. If it's something I'm trying to get rid of out of my account, it's a closing transaction. Don't make it any more complicated than that. Now, in the same regard, when we buy a call or we buy a put, it's the financial term we use for that is called being long a position. Again, we throw so many financial jargon terms at you guys that it's overwhelming sometimes. But nonetheless, we're using the word long. And what that basically means is when you buy something to open that transaction long in your account, it appears as a positive in your holdings. So you will see that literally if you bought 10 contracts, a positive 10 number will appear there because you bought and own those options. If you sold a covered call or you sold a cash covered or naked put and you were selling to collect the income from that, so you're selling that position, then it's called a short option. And what it means when you sell that position, it will appear in your brokerage as a minus position. So if I owned 1,000 shares of Suncor and I sold 10 covered calls on them to collect the income, then it will show minus 10 calls in your brokerage. It'll show as a negative. That's not an error when you open your account, for those that are new. It is supposed to be expressed as a negative. So recognize is that when you buy something and you own it, it's going to express as a positive number. And when you're short it, it's going to show that it's as a minus. Whenever you're dealing with an option where you're trying to generate an income, covered call writing or put writing, it will always appear as a negative. That's just the way. And that's when the cash appears in your account, when you see that. Now, the next thing I wanted to address is the Canadian Derivatives Clearing Corporation, the CDCC. And this is a wholly owned subsidiary of the Montreal Exchange. And this acts as the central clearing counterparty for all exchange-traded derivatives. It's also for futures and other things like that, in addition to options. This CDCC guarantees every side of the transaction is protected. Therefore, it's guaranteed. It's to protect the integrity of the system. When you buy a call or you buy a put, you don't have to worry about counterparty default, where the other person who whoever bought or sold that option that's on the other side of the trade, you don't have to worry about who it is and will I have to sue them if they don't want to honor the deal. That's not your problem anymore. When you, by you dealing with these options through a centralized options exchange, all options are cleared through the clearing corporation, and all counterparty risk is assumed by them. You are going to be honored for whatever right or obligation you had for your option. Okay, so a lot of people find the uncertain. It's like, who is this other person? You don't have to worry about that. Recognize that it's on the other side. It's all guaranteed. Now, what happens through an assignment process? I wanted to just cover this in a little bit of detail. The option buyer at some point decides to exercise that option. That could be done early, or it could be automatically done on its expiration date. But in the end, the buyer had the right to buy it, so it's their choice. So it starts always with the buyer of the option. Now, the options buyer instructs the brokerage that they wish the option to be exercised. So if you bought a put option as an insurance policy, let's say you owned SNC Lavalin from last week, and at the same time you had a $48 strike put option on SNC Lavalin. When they made that announcement of the problems that they were having with the company, and the stock the next morning opened at $38, would you be exercising your right to sell it at $48? Absolutely. You know, I don't want to own it at 30. I want to sell it at 48, where I have the right to sell it. So in this situation, because I bought that put option, I am instructing. I would literally give the broker instructions. Some of the brokers out there allow you to electronically exercise. Some of them require you to phone in your exercise. But one way or another, you're giving them the instructions that you want to exercise your right. Okay? And the broker sends the notice to the clearing corporation. The clearing corporation then sends another broker the assignment. It might be sent back to the same brokerage if there's someone short there. It might be any other brokerage on the street. It doesn't matter. You know, if you're, let's say at TD Waterhouse and you exercise, the clearing corporation might send the assignment notice to somebody at Royal Bank. It's not really, it doesn't even matter to you where the clearing corporation is sending it. Then the brokerage randomly, usually through a lottery, sometimes they use a first in, first out type of FIFOs type of system or something like that, but the broker assigns a client who is short the option. And so if at that moment the option seller is notified of the assignment and the person that's short the option has to take on the obligation. So literally that's a process. It happens overnight. In other words, you give the brokerage the instructions, and the next morning you see that the actual shares transact overnight. And most brokerages have a cutoff time for you giving them instructions for a next day exercise, but nonetheless, that would be what would happen there. Now, you don't have to exercise an option. You don't have to go through the process of taking on stock ownership or selling stock. Recognize you could buy and sell options anytime you want. The options market, there are market makers that are assigned or take on the role of providing liquidity within an options chain. And therefore you will see on all options that there will always be a bid and an ask on options that are worth something. If you're going for very far out of the money, they might show a 0 bid, 5 cent ask, something that's not a probable place to be. But for all options that are within strike prices, there will be a bid and an ask, a place to do business. In the end, market makers are not really in the business of taking the other side of your trade. They really want to make their money off spreads. It's sort of like a bookie. In the end, what they want to do is be the middleman, bringing two parties together, and they make a spread income for having facilitated. These market makers will hold a book of options on there, and they'll be looking to offset those. The faster a market maker can get the risk off their books, the better for them, because they're just trying to make money off of facilitating liquidity. And they don't want the other side of your trade. They might at certain situations, but more often than not, they use a term, which we'll talk about Greeks in a moment. They use a term called delta hedging, where they go long or short a certain amount of stocks against their book of options to try to remove the risk of them owning all of them. But the point is, they will play the role of offering a bid and an ask. So that way, anytime you want to close your option, there's somebody there that will do business with you. The spreads on an option are very much correlated with the size, the liquidity of the stock, and the liquidity of the options chain. The more risk there is to a market maker, the wider the market maker will put the spreads. So you'll see that the most liquid options chains will always have or the most commonly traded options will always have tightest spreads, because the options are rotating out of the book at a much faster rate. Nonetheless, the point is that there's always a market for options. And so you can close a position or roll a position before there is any exercise. So even though I taught you what this clearing corporation is and what happens when you get exercised or assigned, but so many options traders never experience an exercise or assignment because they never take it that far. In many cases, they'll use the option as a trading vehicle. They will buy the call or buy the put. At a later point, they will sell it or close it or roll it. And so what I wanted to do is just take a moment to highlight what it is to close a position and to roll a position, so you guys can see what the alternatives to exercising are. Now, let's say in this example, Royal Bank is trading at $53.77. An investor has a February $52 strike call option. Now, the February $52 call option is bidding $2.05. And the March $52 call option is asking $2.50. Why is they're both the same $52 strike prices. Why is the one option more expensive than the other? Because more time, right? There's a larger time value in the March one versus the February one. Now, in this situation, let's say that the investor owned the February $52 call option at $2.05. Now, so let's say they bought it at any nominal price, $1 or whatever. Now, it's coming to the February expiration, and the investor does not want to take on the shares of Royal Bank, but they want to continue to make money off of Royal Bank going forward. And so they need more time on the option, because otherwise the expiration is going to come up. So what this investor does is they would sell the February option, receive $2.05 from that. They would turn around and buy the March $52 call option for $2.50, and therefore you paid 45-cent net debit for extending your time to March and give you another month of time to see your trade through. So you didn't have to take on the ownership of the stock. Yeah, because let's say the February expiration was coming up. You just wanted to continue to participate with the option. There are a number of the option brokers out there in the hallway that allow you to do this as one trade ticket, which is basically where you literally say, for a 45-cent debit, I want to roll from February to March, and they'll literally let you place it as one transaction to roll it. Otherwise, there are some brokerages, you have to do them as two separate trades. You would literally physically sell the February one and turn around and buy the March one. One way or another, whether you do it as a roll ticket or not, it is a taxable transaction. You physically selling one and buying another, that is like a deemed disposition. And you by rolling it, even though you can continue to participate in the stock, by physically having rolled it, you've realized a taxable event. Whether it's a capital gain or capital loss, you are going to have to report that to your accountant and to Revenue Canada. Otherwise, the other thing was that you could close the position, right? And so by closing the position, we would simply, let's say it's the day before, let's say it's Friday of the option expiration in February, and you don't want to end up owning the shares of Royal Bank. I'll give you an example. Well, what if you had a $4,000 tax-free savings account, and you bought one call option on Royal Bank, which obligates you to own $5,200 worth of stock? Well, you don't have the money in the tax-free savings account to actually take on the ownership. So that's something that you would want to close before its expiration date, because you don't have the money to actually go through with the exercise, right? And so in that situation, you would simply sell the option at $2.05 on its expiration, or before its expiration date. So what I wanted to now touch on here is option Greeks and volatility, or the VIX-C. The option Greeks, we just wanted to introduce all of you to the concept of option Greeks. It's something that we focus so much more on our advanced sessions more than our basic, but we want to introduce you to what it is. Now, pro traders use the option Greeks to create all sorts of more accurately hedged positions and so on. But the average trader uses the Greeks to understand how the change of any one of the variables will influence its options price. Now, if you remember about an hour and a half ago when we talked about option pricing, we suggested that it's a math formula. Right? It's based on a model similar to the Black-Scholes pricing model, and it has the input variables of price, strike, time, volatility, dividends, and interest rates into there. Now, when you have something that is calculated mathematically like that, what happens is we can look at how any one of the variables, input variables into the option price, affects the price of the option. And that's what the option Greeks are doing, is that they're trying to determine what effect each one of the different variables have. Now, we throw all sorts of great financial jargon at you guys with the Greeks by delta, gamma, vega, theta, and rho. But what you'll see is what the logic lies behind them. You'll see it makes a lot of sense. Now, the first one is delta, and delta is the most commonly used one by traders. Delta is the mathematical measure used to show the rate of change of an option relative to the stock price. That's a lot of words for basically saying that if the stock was to move $1 and the option had a delta of 50 cents, it would mean the option would increase by 50 cents when the stock went up $1. It means how much did the option price change relative to the to 1 unit change of the stock price. So think of it this way: if right now, if the delta was constant, which it's not, if let's say we thought the stock was going to have a $3 increase in its price, and we bought a $2 call option that had a delta of 0.5 or 50 cents. Then we know that that $2 call option would probably be worth somewhere near $3.50 if we were right about our forecast of the stock going up $3. Like literally, you can use the delta to understand relatively how much the price of the option will change about you being right about your stock. Traders like this because if they, especially technical traders that know what price targets they're setting and where they're looking for a stock to go, they will usually be able to look at an option and say, how much money will I make on this option if I'm right about the stock price making this move? And delta is a way of measuring that. And so you'll see that if you go to any one of the options brokers out here that are in the hallway, you can ask them to show you the option Greeks. And what they'll show you is on one of their screens, they'll click an options chain, and then suddenly you will see the delta appear on there. And you'll see that each option has a different delta. And one of the ways to select what call option or put option you want to participate about your move, you may be influenced by what the delta of that option is. That's just one of the things that you can look at. The next variable is gamma. And gamma is really one of those that is not commonly used by the average retail investor. And I'm sure you'll probably forget it as fast as I say it. But in the end, it's just measuring the rate of change of delta. If you're a program trader and you're a hedger and you're trying to build these big fancy automated trading programs, you want to know what the rate of change for the delta is when you're programming something. But for the average investor, knowing what rate delta is changing is not something that they will commonly use. But recognize when you hear the term gamma, it's just the delta might go from 0.5 to 0.6, from 0.6 to 0.7. And as the delta is changing, it's changing at the rate of gamma is the measure. Now, what I wanted to, I didn't have it in the illustration. I'm just going to go back to delta for a moment. I wanted to make one observation for all of you. An option that gets deeper in the money. Remember, in the money was like when we owned a $11 strike call option on Research in Motion when it's trading at 15. There's $4 of intrinsic value. That's in the money. The more an option gets in the money, the closer the delta comes to 1, which means that there's a point where an in-the-money option will start to behave almost identically to the stock. So in other words, if you go deep enough in the money, if the stock went up $3, you will see that the option also increased by $3. There are options out there that have a very high delta that literally allow you to almost dollar for dollar participate in the move of a stock by going in the money. I just wanted to make that observation. In the same regard, a put option always will have a negative delta because it moves the opposite direction of the stock, right? And so therefore, as the stock is going down, the put option is going up. So it always will show a negative delta. And an in-the-money put option will have a delta very close to -1. The next one I want to cover here is Vega. Vega is a measure of the change in an option's volatility. The implied volatility inside an option is not constant. It's at any one moment, the market is trying to most accurately price that option to reflect all known information. If a new piece of information comes into the market, that might make the stock more volatile or less volatile. And the implied volatility will adjust accordingly. In the same regard, there's market volatility, such as if you, let's say, tried to own stocks during the August crash last year, understand it was a very volatile period. All stocks would have had substantial increases in their implied volatility during a market decline like that. The Vega is trying to tell you what rate will your option price change if the volatility is changing. So if there was a big spike in volatility, what Vega is trying to tell you is that if volatility went up 1%, and Vega was, let's say, 5 cents, it would mean that if an implied volatility in the option went from 26% to 27%, it would mean that option might go from 40 cents to 45 cents. Literally, it's telling you that there would be a 5-cent increase in the option if volatility was expanding. Again, that's something that's more advanced traders tend to use when trying to forecast volatility. But if you ever reach a stage in your trading where you start observing volatility and other things like that, Vega would be the Greek that you would use to determine how it affects your options price. Now, I have an illustration here of implied volatility. An option is really priced based on a probability distribution curve. It literally just right out of a stats book, you can put it on there. Literally, at any one moment, the option pricing model is saying what would be one standard deviation higher or lower for the stock over an X duration of time. And then once that is known, then they can say what option price do we have to charge to reflect the actual probability that that stock will go there. That's how an options price is determined. And so literally, in this example here, one standard deviation higher or lower on a $50 stock may be $45 to $55 range. And so a market maker is literally, or an option, anyone pricing the option would be saying there's a 68% chance that that stock over that X period of time will be between $45 to $55. Literally, within the option pricing, it's priced that way. Now, the environment can change. And so if let's say the stock market started crashing, like an August-style market decline, well, volatility would almost immediately start to increase. And what will happen is the rate of change in volatility will kick in. And so when we have that standard deviation of that probability model, what will happen is the curve will expand this way. You see how it's stretched? What happened, it stretched, and as it stretched, it now is saying that a one standard deviation move higher or lower is, let's say, $42 to $58, no longer $45 to $55. What's happening is as the market becomes more volatile, the option has to now reflect that the stock can move much farther than they originally anticipated. And therefore, that option will become more expensive. There are traders that actually try to profit from this. I'll give you an example. Right now, the implied volatility of the stock market is actually near 52-week lows. It is very cheap to buy an option right now from the range it's been over the last year. And so right now, if you bought a put option because you felt that there could be a market correction, you actually would be buying that put option at a period where it's relatively cheap to buy. Now, if the market, for whatever reason, started to crash and started declining, volatility would spike. In that period, not only would you be making money from the price going down, but you would also be benefiting from the fact that volatility is increasing the value of your option. So you actually can profit twofold. In the same regard, if you tried to buy an option at the stock market bottom, let's say this was August 9th, and we're sitting right near the stock market lows, and you say, oh, the stock market's so low here, I'm going to buy a call option. Well, at the time, the volatility was so high, the analogy I would give you, actually, I'll give you a real estate analogy. Let's just say you owned a beachfront house on the coast of Miami. And you had a nice little place, you bought it, you've been renovating it, working on it. You got a quote for hurricane insurance, and it was like $3,000 to buy the hurricane insurance, but you've been so busy you forgot the phone. So you leave it sitting on your desk. A month passes, you haven't done anything, and then suddenly you're driving to your little vacation home, and on the radio they say, "Oh, there's a tropical storm forming on the shores of Miami." Well, you're like, "Oh, I now have to go and buy that hurricane insurance." You call up the insurance company. Do you think they're going to sell it to you? No, and if they do sell it to you, they're going to charge you $6,000 or $8,000, not $3,000. What happens is that there was a premium because of now known information. In the same regard, when you try to buy options at a market bottom, when there's huge amounts of fear and volatility in the market, you're paying a hurricane-style premium for your options. You're almost overpaying for them when you buy them in that time frame, and you actually lose money from volatility contracting in a subsequent period when the stock market declines. The way to look at how a declining volatility looks, it's sort of like this. If the environment is calming and everything is going down, this bell curve will actually shrink. Where now the market is saying one standard deviation higher or lower is only a range of $47 to $53. What literally at any one moment the market through its implied volatility is telling you what is the expected range of the stock over that duration. And what's happening is when we use the option Greek Vega, it is telling you what effect will 1% change in that volatility affect the price of your option. And so as you get more and more sophisticated, if you wanted to understand how volatility is affecting your options, you're going to be looking at that Vega term in your option quotes. The next one here is theta. And theta is actually quite useful for many of you. It is the measure of the rate of which the option is time decaying. Remember we said that an option loses a little bit of its value. Now time, unless one of you guys have learned how to go back in time, time only moves forward, at least for me anyway. Now time is going forward, which means that every single moment, every second, every thing, we're that much closer to that expiration date. And so theta will always be a rate of decay. Now, what theta is doing is saying if I hold this option from today till tomorrow, how much of the option will decay in one day? So if the theta is 4 cents and you have a $1 option, by holding it from today to tomorrow, you know that it will be roughly 96 cents if the stock opens the next morning at the exact same price it was trading. What each one of these option Greeks does is it tries to look at how each one of the input variables affects your option price in isolation. Obviously, all the variables might be moving at any one time, but it's allowing you as a trader to try to understand how this one variable will affect me. So if you let's say own an option that is expiring in 2 weeks, and you pay $1 for that option, and it's only got 2 weeks of time, you have to recognize that the theta will be very high. Because you have literally 10 trading days until that option expires. And if that stock does nothing, every day that time decay is just going to kick in harder and harder and harder, and the theta is going to be larger and larger. And so you're able to actually see how much money that option will decay from one day to the next. In the same regard, if you buy a 1-year option, the theta will be very low because you have like 365 days. So one day going from 365 days down to 364 days, there isn't going to be very much time decay, is there? In general, what happens is that you can actually quantify that by watching that variable theta. Again, a lot of beginning traders don't need to use the Greeks right off the bat, but understand the reason we're trying to teach it to you is for you to recognize how an options price is determined, and 2, how you can try to actually see some of these variables in your trading. Now, the last one is rho, which is simply trying to see the effect of interest rates. And recognizing that a change in interest rates will change the way interest rates are being discounted into the options price. Now, this has become sort of a not so important variable because we've reached a period in the global economy where all the central banks have like a zero interest rate policy and interest rates aren't going higher anytime soon. And so, so knowing how interest rate changes are affecting your option are really not so important. But if you think back 10, 20, 30 years ago, changes in interest rates would be something that had to be taken into account when they were 10, 15%. Nowadays, it's not so important, but back then, this Greek was created to try to understand how changes in interest rates would affect your options price. Now, the last thing that I wanted to talk about on this section here is the volatility index. On the Montreal Exchange, they have what's called the VIX, the Canadian VIX or the VIX-C. And this is a measure of the implied volatility in the S&P TSX 60, which is the 60 largest stocks in the index. So when you look at a graph of this, you're literally looking at a graph of the historical implied volatility that was being priced into the index. So if you ever wanted to understand Vega and how volatility changes, you just have to go and look at the VIX-C to see how volatility has been changing in the broader markets, to see how volatility would affect you. And more importantly, what stage the market is in. Is this a period where options are very cheap, or is this a period where, on a relative basis, options are expensive? You can see that by looking at what the volatility is being priced into the option. It's also a proxy for investor sentiment. What you will literally see when I pull it up is that spikes in volatility tend to occur with market drops. I don't know how many of you ever heard the kind of analogy of the market rises like an escalator but drops like an elevator. But it's so true. Right now when the market's going up, it's up a little bit every day, everything's fine, everything's calm, and then someone hits the panic button and that thing goes straight down, right? And so what happens is that it's a very natural relationship that during market rallies, volatility is declining because everything is calm, everything is fine, there's nothing going on. And then when everyone hits panic and someone yells fire and everyone's running for the exit door, then suddenly everyone wants to buy puts to ensure their downside risk. But now you have to pay the hurricane premium insurance to buy them because the volatility has gone up. Right? It's just the nature of the market. And so what happens is you can actually watch the charts on the quotes on the VIX-C to kind of get a sentiment of how investors are thinking or behaving by watching the option premium that is being priced into those options. So you can see here, I have a chart here of the VIX-C. It's overlapped with the actual S&P TSX 60 chart. And what you'll see is that they tend to move inversely, which means that substantial drops in the stock market tend to be correlated with spikes in volatility. So literally, market bottoms, you can actually identify that at market bottoms, the volatility is usually at a very high level. It's because you're in the middle of the hurricane. And everyone that wants to buy put insurance and other things like that have to pay a substantial premium to do so. So I encourage all of you to visit the Montreal Exchange site and pull that up. On the U.S., there's also the VIX, which is looking at the volatility of the U.S. market. So whether you're looking at the Canadian market or the U.S. market, there are these charts of the volatility that allow you to see how the market is pricing risk. Really, it's a chart of how much risk is being priced in. That's it. Like if the volatility is low, it means the options are pricing little to no risk. While if it's high, it's telling you that the options are pricing a lot of risk. Now, so what I want to do is just summarize a couple of things for all of you on the uses of these options. Recognize that the most common stereotype people have of options is that options are risky. Before you guys came here today, how many of you guys heard that line? I'm sure all of you heard it. Options are risky. But recognize that options are not risky. Options are a tool. And when you use the tool for excessive amounts of leverage, it could be used to attain a huge amount of risk. But that, in the same regard, that option could be used as protection or as a mechanism for hedging risk or creating consistent income. And there's nothing risky about that at all. And I think the one thing I want all of you to very much leave here today with is the notion that options are a tool. They're neither risky nor conservative. They're a tool. And when you use the tool to attain risk, you can have risk. If you use it for protection, you can have protection. You can use the tool any way you want. There are some fabulous strategies where you can consistently generate cash flow income off of your portfolio. For instance, I publish a newsletter called The Stock Rental Business, where we do covered call writing, and all we do is we target through covered call writing and put writing, generating a cash flow every single year off of our stocks. In the same regards, you could leverage your stocks with, like for instance, what if you had a tax-free savings account and you have only $5,000 in it, but you wanted to control $10,000 of your favorite stock? Well, you could use options as a mechanism of giving you control of $10,000 worth of stock, even though you're not allowed to margin in a tax-free savings account. Again, it could be used for leverage, but yet have a defined loss. You know what your worst-case scenario is. You can use those options for protection. I'll give you a great illustration of using the options as protection. A strategy which we didn't cover here, and I think Jason may be covering it this afternoon, is the idea of a collar. A collar is a combination of two of these strategies we talked about. Now, I'll give you through an illustration of what happened. I was dealing with a client that had 30,000 shares of TD Bank. And basically during last summer, they enjoyed a nice rally in those financial banks as they went up 20+% in that time frame. And when the stock was trading up in the high 80s, we said, well, why won't we lock in these gains? But the idea of buying protective puts on 30,000 shares, the protective puts were costing like $1.52. So his debate was, you know, do I A, buy protection on my stock, or B, buy a BMW? Right? Because the amount of money it would cost to buy the protection on 30,000 shares, you know, like 50 grand disappears quickly, right? When someone's doing it with a $5,000 account, paying $100 for a protective put doesn't seem so dramatic. But when you start talking real money, you know, outlaying that kind of money for protection seems like a lot. But what ended up happening through selling a covered call, remember, for income, they sold a covered call on the TD shares and were able to collect $30,000, $40,000 of income, and then used that money to buy the protection. Then that summer, when TD started dropping in August, he was able to get out of all of the shares at $84, and he bought them all back in the mid-70s. Right? And in the end, it didn't cost him a lot because they used the income from the covered call, which capped the upside, to pay for the cost of the put. You see, when you start combining options together and strategies together, there's an infinite variation of these amazing things you can do. That's why there's an advanced section to this show, because once you start combining all these different strategies together, you get all sorts of different outcomes. But what I really want all of you to recognize is that you no longer are trapped in the only in what is a long stock investor mentality of I have only a simple decision: either I own it or I don't. Here you have so many variations of managing risk, averaging down, doing all sorts of fabulous things that were simply not available to you if you never took the time to educate yourself. So I commend all of you for coming out here today to learn this stuff, because I'm sure many of you are going to leave here with all sorts of, the hamster wheels are going to be turning, I'm sure, in terms of ideas.